Well, after COVID, we saw higher inflation. And as a response, the Fed increased interest rates at the fastest pace that we've seen in history. And they've remained relatively high. Now we're talking about lowering interest rates with an expected rate cut coming around the corner at the Fed meeting next week. So, what does that mean for savers and investors? Well, to give us perspective, we'll talk with Tim Stearns, CFP, founder at TJ Stearns Inc. Welcome into Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP. Tim, always a pleasure to have you here on the program. Thank you for joining us.
Peter, thanks for having me.
Well, we think that the Fed in the upcoming meeting and announcement will finally cut interest rates. We're expecting a quarter point, I think, is what has been talked about and is widely accepted. Kind of Vegas odds are on a 25 basis point reduction. What does that mean for us, Tim? What are we going to see?
Well, Peter, people who own bonds currently will be happy because it's going to actually, make their bond values go up, but their current bonds. But at the end of the day, things like annuities and that type of thing that have been paying out in record numbers will be going down.
So is it a time to rush out and get into those things while interest rates are a little higher, Tim?
Well, they're the best they've been in my 31 years in the industry. So yes, I would say that is correct.
Okay, the Federal Reserve rate decision will be announced Wednesday, September 17th. So yet to be seen, but there is that widespread expectation. Jerome Powell will finally announce a rate cut. We've kind of been waiting for this with bated breath. I think Europe has lowered their rates seven or eight times, while we've only had two rate cuts of a kind of minuscule nominal amount.
But exactly, and I think they've been slow to it, but I'm good with it. A lot of sabers are jangling that they should be that he should have done it months ago and that type of thing. But one thing I don't want to see is a Federal Reserve chairman that's loosey goosey with this type of stuff. He's ultra conservative, which is what I think we need right now because a lot of things are kind of up in the air.
So you think he has been intentionally tight with the policy and diligent in understanding the reasons of and the power of the tools that he has available?
Yes, I think he learned from
I
his
know, I know
less.
he's sort of been at odds with Trump about
Right.
this.
Right. And I'm not trying to get political here, but when it comes to, knowing economics and that type of thing, I'm going to say Jerome Powell has done a decent job. I also think he has learned on the job because as we saw, interest rates went as high as 9%. I'm sorry, inflation went as high as 9%, and he was kind of slow to the party there. So now we're going the other way where he's going to be slow to cut the rates because he doesn't want to see it go on a whirlwind of inflation for people. So I
Well,
am good with it.
once again, we are talking with Tim Stearns, CFP, founder at TJ Stearns Inc., which is, of course, the home of the Protect and Grow written retirement blueprint. If you would like to get your Protect and Grow plan put together for your retirement income, ladies and gentlemen, pick up the phone, give a call, 800-640-2256. That is 800-640-2256, 800-640-2256. Or you can visit online and find out more, as well as schedule a time for a conversation or consultation. No cost, no obligation at the website, tjstearns.com, tjstearns.com. Tim, retirees seem particularly subject and sensitive to these kind of changes in our interest rate environment and inflation.
Well, I mean, think about it. Their CDs, their savings, their money markets that there has been their go-to the last couple of years are going to decrease. In fact, I've seen some banks are starting to, slip down too. If you're buying something, on the other hand, which now a lot of baby boomers are, it's a good time for that because mortgage rates will go down. But at the end of the day, the things that I'm going to see are, lower CDs, lower saving money market interest rates, and of course, annuity payouts are linked to interest rates. So we'll see lower rates equals guaranteed lower income. And that's why we're making sure people understand that, you need to take a hold of it if you want it now, because, once purchased, the rate is locked for life, which is excellent for these people. So buying during high rate periods, they'll provide stronger payouts.
Tim, the thought is that by lowering rates, they stimulate the economy, and certainly not the only area of the economy. But as an example, kind of a microcosm, the housing market has been notoriously slow, kind of at a stagnant point over the last year, year and a half, I think,
Yeah.
across the country. Not a lot of buyers interested at relatively higher interest rates. And so the inventory of for sale homes on the market has remained higher than average and historical. Do we see that lowering interest rates is going to be a boon to the economy in such areas as housing? And does that have ripple effects on the greater economy?
Well, I think it will create, it's not in a vacuum, right? It's not gonna be overnight that things are gonna change. I do see it, speeding up the ability for people to start to buy houses again and people to sell them. Because I mean, think about this. A lot of people are in it under, sub 3%. So why would they want to move? That's a great interest rate that they'll probably never see again in their lifetime.
And a lot of smaller companies, those small cap company sectors of the
Mhm.
market, Tim, those rely on financing to run R&D and the overhead that they incur. And so perhaps this is a move, the expected move to lower interest rates. Perhaps that is something that can stimulate specifically, particularly that small cap sector of the economy.
I definitely. I mean, if you can borrow money for less, that's going to help these smaller companies that need to get loans, and also small businesses. If they're looking to expand and that type of thing, if they can get their hands on cheaper money, they're going to do it.
Not that it is just smaller companies that borrow money
Right.
or finance things. Not by any means. In fact, those larger companies, those are the ones, Tim, that issue bonds. And what we expect to see is that those bonds are going to now pay lower interest rates. So, should retirees begin to prepare for changing cash flows?
Uh, I mean, if they've got annuities that were bought in the last couple of years, no, things will be good. But if they're, have bought old annuities, old bonds, that type of thing, yeah, I mean, the new bonds that are going to be generated, as well as the new annuity rates, are going to be lower. And we're telling anyone who will listen to us that if you want the highest I've seen in my 31 years, give us a call at 800-640-2256, and we'll help you get into something like that.
When you talk about this is the highest cash flow, explain that for me. What do you mean? Like dollar in, dollar out? What is the cash flow ratio?
Well, we've seen companies that are paying, again, the top percentage points that I've ever seen. So what that means that if they're paying out, 7.5%, maybe now they're going to only pay out 7.25%, 7%. And what I've noticed with baby boomers and people who are retired, every interest rate counts to them, every cut. And they want to make sure that they can, the biggest concern is paying their bills. And when you are cutting interest rates, yes, that's going to cut what you get, what your take home is.
And Tim, since 2022, 2023, we've been discussing cash flow rates in the 5 and 6 and even 7% range, where for the 30 years prior to that, it seemed like we were relegated to the 4% rule, the 4% cash flow, or maybe even less, the 1.5, the 2.8. There were many academic sources that suggested that we needed to be satisfied with a much, much lower cash flow rate.
Right. Dr. Wayne Pfau actually brought it down in sub 2%. He was talking about. And so, I mean, which is ultra conservative, but most of the studies that I've seen the last 2 or 3 years have been around the 2% rate. So with these cutting interest rates, that's going to affect all that.
However, you're saying that with those same dollars, let's call it, our lump sum at
Mhm.
retirement. Let's say it's $1 million.
Yeah.
Instead of taking a 4% cash flow, $40,000 for our income and needing to be satisfied with that, bumping that up to even a 5% cash flow. That's not 1% more money. That's now moving to $50,000 a year. That's a 25% higher income per year, Tim.
Right, exactly. So I think, and what this comes down to, Peter, is just literally having a plan that you can, tie yourself to, that that things are going to be okay. Interest rates stock market aren't going to affect you that badly.
Well, again, if you would like to get that protect and grow written retirement blueprint, your blueprint for generating reliable retirement income, ladies and gentlemen, pick up the phone, give Tim Stearns, CFP, TJ Stearns Inc. call 800-640-2256, 800-640-2256, 800-640-2256. Tim, we have talked about this inverse relationship between the value of bonds and interest rates. Can you explain that aspect of how these two things are correlated?
Well, think about this. If you have a bond that you've bought in the last couple of years and the interest rate is going to be cut, then the new bonds being issued, let's say that they're cut by 1/4%, then the new bonds are going to be 1%, 1/4% less than what they were being issued at before. So let's give an example. Let's say I have a 6.5% bond from General Electric, and they're going to issue new bonds. They're going to do them at, let's say, 6.25. And so what happens is your 6.5% bond that was issued in the last couple of years is going to be worth more to people that want to buy higher interest rates because the new ones are being issued at a lower interest rate. So there's actually an inverse relationship that when interest rates go down, bond values of previous bonds, the value goes up.
So, Tim, if I'm equating this to like the housing market, right? And I am in the market to buy a house, interest rates are 6%. And I know that I can afford a monthly payment of let's call it $4,000 a month, right? But then interest rates go down to 5%. My same $4,000 a month can now buy a much larger house. Is that kind of the same thing on the opposite side of what these changes in interest rates mean?
Yes, Peter. As interest rates fall, the values go up of houses, bonds that were issued previously, et cetera.
So new bond buyers, though, are going to be faced with less income that they can generate from those bonds. Is that how that side of it works?
That is totally correct. And think about it. You were getting interest rates of 6.5%, and now you're only going to get 6.25. So that's going to be less money coming into your pocket.
And retirees, by and large, Tim, are more conservative in their investment risk exposure and risk tolerance. Generally, they move toward bonds and fixed income as we get toward retirement times. So does that mean retirees relying on bond income need to be satisfied with reducing their cash flow?
Well, if they have a plan, hopefully not. But a lot of these people, the actual thing that I'm seeing a lot of is, baby boomers are having way too much exposure to stocks. So I would hope they are having some bonds, and they should be getting them now before this interest rate cut comes.
Bonds tend to be equated with protection, but the
Mhm.
income that they can generate depends on timing.
Of course, right. So I mean that is the flight to safety versus interest rates. I'm sorry, the stock market being a little more volatile. And we try to explain that to people that if you're out there and you have 80% of your money in stocks, this is a time to maybe take pause and realize that you should have some more bonds than having all those stocks.
Again, we're talking with Tim Stearns, CFP, your certified financial planning professional, ladies and gentlemen, Chicagoland's resource for the Protect and Grow written retirement blueprint. And if you would like to get yours put together, that is a complimentary courtesy service that Tim Stearns, CFP, and the team at TJ Stearns Inc. offer for listeners and viewers of this program. All you have to do to get the conversation started, to get that process going, give a call, 800-640-2256. That is 800-640-2256, 800-640-2256. It seems like this next rate cut, Tim, has been talked about, debated, and a long time coming. Why have we seen this debate? Why has it taken so long for us to get here?
I think that, a couple of years ago, inflation went crazy and they raised the interest rates to stop that, and they don't want to see it go back. And if you remember, the Fed's goal is to get to 2%, and they really haven't gotten there consistently. And so they are very gun shy about reducing the rates because they feel like, guess what? inflation is going to come back and it's going to go roiling, in the everywhere. Not to mention that you have these tariffs, and that scares people too. So, they could be uber crazy here in the stock market as well as the bond market.
Again, we are talking with Tim Stearns. And Tim, I know that you're a fan of balance with access to both sides of the financial world, risk and equities, stocks,
Yeah.
bonds, mutual funds in the market, as well as safety and protection. And we talk about a couple different types of safety and protection, protecting principal,
Yeah.
protecting income. Both of those are important. We mentioned annuities earlier, and
Mhm.
specifically, how does an annuity function to protect principal and or income? And are those the same or uh, and combined items, or are those kind of separate items when you talk about the safety of principal and the safety of income?
Well, the safety of principle is paramount to why the success of an annuity is out there, because people want lifetime guaranteed income for both, if you're married, for both spouses. And so the annuity does that. And then in addition, the payouts, people are planning on using that money for paying their bills, which is paramount to success in a retirement. So they are, both related, and you need to make sure that you understand how that's going to guarantee lifetime income would make me sleep better at night. And that's why my wife and I own annuities.
Inflation, however, Tim, comes and goes,
Yeah,
right? Is
sure.
that we're probably not done having the conversation about inflation. I wouldn't
No,
expect it. At
no.
least maybe now it's more close to our target and historical averages, but some amount of inflation is healthy. It's something that they want. They promote that. But over
Yeah.
time, retirees are particularly subject to the effects of inflation.
Well, one of the things we talk about in my retirement classes is we show the example in 1976, you could buy four tires for $200 at Sears. And now those same tires are over $1,500 at, like, let's say, a Costco. So people know when it hurts their pocketbook or their wallets. And inflation is, we call it the silent, thief, and it erodes your dollars. And with, a lot of these annuities, you can get pay raises, if the market cooperates, where you're locking it at a new higher rate of payout. You know, those are the things that we look for as guarantees and staying up with inflation.
I'm not minimizing it because a single year where there was 8% inflation, Tim, that was painful. We all felt that. But
Yeah.
over the course of a decade with 3% inflation compounding, ultimately
Yeah.
that's going to be even more impactful.
Exactly. And thankfully they got that under control. But I think that if they cut interest rates too much, we could be in that situation again.
Once again, we are talking with Tim Stearns, certified financial planning professional, your resource, Chicagoland, for a common sense approach to planning for your financial investment and retirement future. And Tim, part of securing a retirement future, having some protected income, and now might be the time as we look at maybe the sunsetting, at least temporarily, on these high, generous, advantageous rates for fixed income.
I think that right now is the best opportunity. I tell people, anyone who will listen, in my 31 years, I've never seen interest rates this high, for annuity payouts and all the good stuff that goes with that.
Tim, an opportunity that a lot of people don't even realize that they have, if they are participating in a 401k and have reached 59 and a half years of age, this is a
Yeah.
big milestone that people need to be paying attention to. Can you talk to us about why this is a particular time to pay attention to?
Well, I mean, it's an opportunity to take out money when you're still working. Most companies allow you to take out money at 59 and a half. So you could actually take the money out of your 401k and move it into an IRA that could be self-directed. You could have an advisor help, and I do that with all of my clients, including my siblings. The important thing is to get your money out of that particular 401k, because most of those 401ks are buy and hold or they're target date funds, et cetera. There's not a lot of activity in there that's going to help you get through retirement. And I don't want to see people right now when the market's at its all-time high, get a correction that would, be detrimental to their retirement.
And Tim, I know that those target date funds are a very popular option, a flavor of choice inside of 401ks. Those often are very interest rate sensitive.
Right, exactly. Especially, I always show people the example of the 2015 target date fund from Vanguard was down 15% in 2022. So, I mean, they're not foolproof. And I would want to bet on myself before I'm going to bet on a company's 401k to make sure that I'm okay.
So, what can a retiree do if falling interest rates shrink income from traditional sources? Well, we've got to look at diversification at that point, right, Tim?
Right. And there's so many different and the diversification tool that I would use is to use that if you're over 59 and a half to use that to move it over. Or the other thing we're running into a lot of are people that have old 401ks that they haven't looked at in quite a while and they don't really know what's going on over at the old company. Consolidate. There are no free lunches. So don't think for a second that your 401k is free to you. And the bigger part that we've run into is people saying, "Oh, well, if I move my money into an IRA, I won't get my match." Well, no, that's not true at all. You get your match, and you'll be still deferring some of your paycheck into that, but the heart of your money will be over into another IRA that has stop losses, it has active management, and it has a professional certified financial planner looking it over.
Strategies like dividend paying stocks, real estate
Yep.
investments, structured products, or
Yep.
hybrid annuities with guaranteed lifetime income benefits. Set up within a plan, right? There's a
Right.
systematic withdrawal strategy, and not all the income should come from one source.
Right. And, open up your world to all the diversification that's out there. Because right now, if you're over 59 and a half, you're beholden to what they have in those plans, and I think that there's a lot more out there, like you just said, dividend paying stocks, real estate investments, structured products, or even hybrid annuities. There's so much you can do that I think is better than just your milk toast 401k.
And Tim, a relationship with an experienced, qualified professional,
Yep.
a fiduciary, a certified financial planning professional, such as yourself, Tim
Yep.
Stearns, CFP, that relationship and the plan, Tim, that you help people put together. A plan is flexible, a plan adapts, and the relationship with that advisor is what's going to help to keep it on track regardless of what rates do, because while we're anticipating some change here in the near future, things are going to continue to change, I have a feeling, for quite some time to come.
I think that there's no crystal ball, but I mean, I'm staying up on this stuff better than most. And 31 years and some gray hair involved in this has definitely helped me stay abreast of what's going on. And I've seen it before. I'm seeing a lot of financial advisors out there, very interesting to me, who've never seen a true bear market.
Well,
They're in their 30s, they don't know what they're talking about. They've had a nice 15-year, and all stocks always come back to you. I don't agree with that. Yes, they probably do, but what if it's not at my timing?
hmm.
That's scary. And I think a lot of people don't realize
What was the original hair color, Tim? I know you said a
that.
few grays. Yeah.
Oh, wow, Peter. It was brown. It was brown. And then I had three boys, and then I was in the financial markets for 31 years.
Yeah, yeah. For those watching on the video, you'll
Yes.
understand the joke here.
Hmm.
But Tim, we always appreciate the stress that you take on for us on our behalf, right? That is something that relationship with an advisor should involve. Is that, yeah, we're always going to worry about our money, right? But handing off some of that worry to somebody to help us navigate those stressful times and events. And I know, Tim, a lot of your job is, yes, understanding the financial markets, but also understanding people and making sure that they're making the right decisions at the right time.
I see so many people right now making the wrong decisions where they're just, going, all in on the stock market. And if they pull the rug out, people are going to be hurting really badly. And I can't emphasize that again. I'm not a doom and gloom guy, but I am cautious. And I tell people all the time, we are not the tortoise. Excuse me, we're not the hare. We are the tortoise. That is the analogy I like to use because we're not going to do some flash in the pan. We don't approach people with this, that, and the other thing, the newest flavor of the day. We don't do that stuff.
By the way, Tim, a very distinguished look for you.
Yes, that's what I tell myself every morning.
Falling interest rates can mean rising bond prices, but that's actually probably already baked in a little bit here, Tim. The market is a forward-looking indicator, meaning things like that, the
100%.
expectations that the market holds are probably already worked into some of the prices.
Absolutely. You're seeing mortgage rates dropping. I mean, they know what's coming up, and I'd be really shocked if on September 17th they don't make some moves of cutting interest rates. I'm nothing extraordinary, but it's going to cut the payouts on annuities, and it's going to cut you on your CDs and all that other stuff.
Well, the question then is not whether rates rise or fall, but whether or not your plan is built to adapt, exploring alternatives, diversifying income strategies, having the Protect and Grow written retirement income plan will help you account for rate and rate changes no matter what the environment is. And retirees, again, feel this in their cash flow, are more subject and prone and susceptible to changes in inflation and interest rates than most any other demographic group. So as you are moving through retirement or preparing for it, make sure you have a dynamic plan and a relationship with an experienced, qualified professional, a certified financial planning professional. And that's exactly what Tim Stearns makes the offer for here on the program. If you would like to speak with a certified financial planning professional, give a call to TJ Stearns Inc. Talk with Tim Stearns CFP. Get your Protect and Grow written retirement blueprint put together. 800-640-2256. That is 800-640-2256. 800-640-2256. And in short-term memory, Tim, interest rates have been higher, but in the grand scheme of things, like over the last 25 years, these higher interest rates were kind of just a flash in a pan. We've been in lower interest rate environments for an extended period of time here.
Yes, and I mean they're about to come down a little bit, but not a lot. And that's why I still think though every penny counts when you're in retirement.
Well, if you would like to take advantage, of course, each and every program, we make one big offer on the program, and that is to put together for you your own personalized Protect and Grow written retirement blueprint, ladies and gentlemen, addressing all of the pillars of a sound financial foundation and stability, income, investments, taxes, healthcare, legacy, all encompassed and personalized to you with long-term vision, diversified strategies. Pick up the phone, give a call, 800-640-2256. That is 800-640-2256. Tim, always a pleasure to have you here on the program.
Thanks, Peter.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.